Are you interested in investing in the stocks and shares market, but you need more information so that you properly understand before investing? You have come to the right place. In this video, I break down the basics you need to know in order to help you start your investing journey. Stay tuned to the end where I cover some of the most important considerations you need to make. Hi, if you're new, welcome. My name is Karen. I am a qualified chartered accountant and entrepreneur based in the UK. I am on a financial freedom journey and I am passionate about helping you with tips and strategies on personal finance and wealth creation. If you're interested in this sort of content, feel free to subscribe and turn on notifications so you don't miss anything. What is investing? Investing is putting money away with the aim of getting a return. When you do this, you are known as an investor. Returns can be in the form of income or capital appreciation. Income includes interest, dividends, or rental income. Capital appreciation would be the increase in value of that item, i.e., when you purchase a house today for £200,000 and in 5 years' time it's worth £500,000. So it's increased in value by £300,000. If you are on a financial freedom journey like me, I recommend investing so that hopefully you can retire early and live off the income from your investments. There are 6 broad categories of investments or asset classes, namely 1. Equities, which are stocks or shares. I will explain these later in detail. 2. Fixed income assets, being bonds, which are essentially fixed-term loans bought by investors who receive interest until the end of that term. There are 3 main types of bonds: government bonds, known as gilts, company bonds, and saving bonds. 3. Real estate, being physical property and can be residential, commercial, or industrial. 4. Commodities, physical goods such as gold, copper, or oil. 5. You have futures and other financial derivatives. This category includes futures contracts, the forex market, options, and a number of financial derivatives. The final one is cash. For example, money you put into a savings account with your bank. And for this to be a real investment, the interest would need to be higher than the inflation rate. Otherwise, your money is losing value. Inflation is the rate at which prices of goods and services increase. That rate, as at March, was around 1.5%. So you're looking for investments that give you a return higher than this. Cash is the most liquid of investments, and you have easy access to the money. Because of this, it's the least riskiest of the asset classes and tends to give you the lowest return. Click the thumbs up icon if you're interested or have invested in any of the above. What is an investment fund? Funds can fall under any of the main categories of investments I just described. They are not specific investments, but a general term for a group of investments. Example, mutual funds, exchange traded funds known as EFTs, or index funds. Let's look into these. An index fund is a mutual fund or EFT that is designed to track the performance of specific index. For example, stocks, bonds, or any other type of investment. Examples of index funds are the FTSE 100 index, which is a list of the top 100 performing companies on the London Stock Exchange, or S&P 100 index, which includes 100 of the leading US stocks. Going on to mutual fund. This is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, and so forth. Then finally, we have an EFT. In many ways, it's similar to mutual funds. However, they're listed on exchanges and the EFT shares trade throughout the day. So in other words, a fund is another way to buy shares. Instead of buying a small ownership in a company directly, you give money to a fund manager who then combines it with other money from other investors to go and buy shares on the stock market. Each fund is made up of units. So if you want to invest in a fund, you buy units. The value of each unit will rise or fall or even stay the same, depending on the demand in the market for that fund. For example, if you want to invest £1,000 in a fund and each unit costs £2, you therefore can buy 500 units. A few months later, let's say each unit is now worth £2.50. So your investment is now 1,250. These funds tend to group companies by similarity, which can be geographical area such as Europe, or the industry that they invest in such as technology, the type of investments that they make such as bonds or shares. So you can select which fund you want depending on the risk you are willing to take. This is called your risk appetite. Under funds, you have two main types. The first one is passive funds, where no one actively manages the funds. So for example, the S&P 100, that's set, and no one is actually working around to change the types of investments. The second one is active funds. This is managed by a fund manager where they try to find the best mix of investments for you. Active funds come with a charge because there is someone working to get the best return for you, compared to a passive fund which has a lower charge. So shop around for the lowest charges, ideally below 0.5%. Let's go in depth with stocks and shares. These are small slices of a company that are available to investors to buy and sell. A company creates these shares in order to raise capital, which they can then use to grow their business. So you own a part of that company. You might have wondered what the difference is between stocks and shares. You may hear people use these words interchangeably, so I will shed some light on that. Shares refer to ownership in specific company. So you would say, I have shares in Netflix, whereas stocks describe ownership of shares in general. So this relates to many different companies. What is the purpose of buying shares? You buy shares with the hope that the share price will increase in value, which is the capital growth, or to get an income if the shares pay dividends. Shares are then traded on the stock market or exchange, which is a place where buyers and sellers meet to sell shares, for example, the London Stock Exchange. For the big companies and for the smaller companies, the alternative investment market. Share prices are affected by things such as companies' performance, general economic conditions such as the coronavirus, and how investors feel about the company and the wider economy. There is a risk involved in investing in stocks, as prices can go up or down at any given time, and there is no guarantee that you'll get your money back. You have two main approaches you can take when it comes to investing in stocks. One is day trading. This is quick buy and sell trades, which may result in quick returns. This tends to require a lot of time and skill. The second one is long-term investing. This is when you buy and hold trades which are for a number of years, so the minimum being 5 years and going up. Let me know in the comments if you're interested in short or long-term returns. Today I'll be looking more at long-term investing. Some people are discouraged by the drop in share prices, as was seen recently due to the pandemic. You shouldn't be. It's expected that these drops will happen. It is rather expected that there is an average growth in shares over a long period of time. So at what age can you start investing in stocks? Generally speaking, you can start from the age of 18, but there are options for younger people such as a junior ISA, which I will cover in the above video. Next, how much return can you expect to make? You might have read that the stock market historically returns an average of 7% to 8%. But I think a 4% return is more reasonable, which is the return over a long term and after taking into account inflation. Holding shares in just one company is very high risk. Ideally, you want to spread the risk. You can do this by diversifying and buying shares in a variety of companies and investing in different assets or different countries. You can also diversify by putting your money into pooled investments like funds, which we talked about earlier. How much should you invest? If you have money in savings, I encourage you to consider the following. 1. See if you're paying any high interest debts and consider clearing those first. Secondly, if the money you have in savings is not being spent at the moment, or that you need to spend in the near future, and it's not your emergency fund, then consider investing so that your money can work harder for you. Bear in mind, you should never invest more than you can afford to lose. So now that you understand stocks better, you've reviewed your finances and seen that you have the money to invest, the next question is how to invest. You do this through an investment platform. This is essentially an online service which allows you to buy and sell and hold stocks. Examples include AJ Bell, Hargreaves Lansdown, and Vanguard. I will cover in another video step by step on how you do this. Another important consideration is tax. One way is through investment ISAs, which are like a wrapper so that you pay the least amount of tax as possible. I will cover this in a separate video, so if you want more information, you can watch. It's really important that you get the most out of your investments. So we want you to pay as little tax as you can, and investment ISAs are a good way to do that. I encourage you to do as much research as you need. What I have shared in this video is for information purposes only. So if you need advice, speak to a financial advisor. I'll be uploading more videos on stock investing to help you on your journey. If you have any questions, feel free to leave them in the comments. And I hope you enjoyed this video, and let's meet in the next.